All right, cool. So yeah, this is ideally what your risk reward setup should look like. And how do we use risk reward to identify a high probability trade? So if your risk reward, for me, typically, if it's greater than 3 to 1, I would consider that a high probability trade because you're only risking $1 to make 3. Right. And when there's a setup like this with the technicals in your favor, so obviously the things have to line up in your favor. There has to be time frame continuity or like some bearish setup or a bullish setup or whatever it may be. You have to look at other outside factors. But if the technicals are in your favor, then this is something that you can size in a little heavier on. Right. These are the high probability trades that you can size in heavier on because there's very little risk for the reward that you might get. And these are the plays that double and triple your accounts, not the earnings plays, and not full porting 0DTEs or full porting anything for that matter. Okay. But anyway, these are the trades that you want to size in heavier with, because when everything lines up and the RR is there, and you're only risk, like if you can go in super heavy, or not even super heavy, but like relatively heavy compared to most of your positions with a hard 10% stop loss, not because just 10% is a random number you throw out there, 10% because of the technicals that are there on the chart for you, right? 10% stop loss with a 20%, 30, 40, 50% profit target, then that is a high probability trade. I would size in heavier into trades like that, right? Now, technicals. So there's 3 main levels that I need to be predefined before I enter any of my trades. So a stop loss, that has to be there. I have to know where I'm going to stop at. You have to know your risk. Number 2 is a whether that's a level or a general area where you're going to average in or average down, right? And number 3 is your take profit. So with these 3 levels, everything is there for you. You don't need anything else besides these 3. You know where your stop is, you know where you're going to add more, and you know where you're going to take profit at, right? There's no selling early because you have your TP level set. There's no stopping out early because you have your stop loss level set. And there's no random ads because we have our average level set too, right? So everything's there. Now, this picture is going to kind of put everything into perspective. So we have a resistance right here, right? This is the start of the gap fill. And then we have a support here, which is your previous low. And so number 1 is right here. So this is our level with a stop loss on a 5-minute close above this resistance, right? So this right above here is our stop. And this doesn't mean a wick up is going to stop you out. It has to close above. All right. So there's 1. Now you have your stop loss defined. Number 2 is any pullback to your buy area is an opportunity to add more. All right. So this level right here at 193.17, this would be a buy level with a stop loss just above. And then any pullback to this general area of 193.17, so within, like, I would say 15 cents, 10 cents, that's a buying opportunity, right? You can keep adding more right here. So if this goes down and you're up nicely and it comes right back up, this, you can add more right here. There's no reason to stop out of this trade yet because it hasn't broken above your level. And then it rejects, comes back down, right? There's no selling. You're not selling because you see a green candle here, right? That's not a sell signal. You have to let the trade play out. You have to give it room, right? This is full time frame continuity down. It's just trying to make a reversal, not going to happen, right? And then you get another massive leg down, goes straight to your TP. And that's where your level sits, right? So when you have these things predefined, everything's there. It's going to take that emotion factor kind of out of the game, right? Now you know where everything is, so there's no questions. You know, like in this entire way down, you can take partials. So like over here, you can take 20% of your position. Over here, you can take 10%, you know, so on and so forth. However you want to do it. Partials is really up to you. Ideal profitable trader, you'd find patterns, levels, you know, do all your technical analysis, right? Then you plan the trade out. So you have your RR set, you have your stop loss, you have your take profit, everything's there. And then you're able to execute profitably. So Number one, you have to use correct risk management, right? And then you have to use correct position sizing, because technical analysis anybody can do, right? Anybody can lay out a bunch of levels on the chart. Anybody can draw out some type of pattern, but very few people can actually take a trade and come out profitable, right? That's the actual challenge, is to come out profitable with the trade that you take. This would be somebody with a plan would have a RR predefined. They would have a stop loss level, average down, average in level, have take partials. They would have a take profit level, let the trade play out, and does not get emotional. And then the complete opposite would be you don't have RR predefined, or your RR is off. You don't have a stop loss, right? Either that or your stop loss is based off a contract, right? You are like negative 20% on your contract, you'll stop out. Whether, like, while strategies like that, they might work for, you know, smaller accounts, and if you have super tight risk management, that might work and you might be able to cut losses quick. But me personally, I like to base my stop losses off technical levels, off the chart. So you're not just stopping out for absolutely no reason. Because if you can stop out at negative 20%, it might go negative 22% and then completely turn around and go 100%, right? And then you just left all that on the table because you wanted to have a stop loss that had nothing to do with the chart. All right. They add whenever they feel like it. They go in too heavy. They'll take profit whenever you feel like it, and they get emotional during a trade and don't let it play out. All right. So there's that. Now we'll switch over to an actual chart here. I'll show you guys a real-time trade that I took and how I played it, where my stop loss was, everything. All right. So this was a trade that I took on Friday. Can you guys see my screen? You guys see this chart, right? Any questions, by the way, for anything we just went over at all? Okay, cool. All right. So we had this break in structure right here on a 2-minute chart. We had a structure break. Not only did we have one right here, but we also had one again right up here. So immediately, as if we're using ICT concepts, we're looking for a fair value gap or an imbalance, right, as soon as you get a structure break. So on this structure break, we got this imbalance right here, this fair value gap from this high to this low, right? And now I'm just waiting for a drop back into this general area to pick up longs, since we have bullish structure, right? We get the drop into that area, right? So this is my setup. I'll show you guys exactly what this would look like. So I would enter in right there. My stop loss is directly below my fair value gap. So I give it a little bit of room because it can wick and whatnot, right? So you want to give it a little bit of room at least. And then my target is going to be the previous high, which is right there, right? That's going to serve as buy side liquidity. So I have this laid out now, and you can see this is a 4-to-1, all right? Yeah, the slideshow will be posted, by the way. So you guys see this 4-to-1 risk to reward. So as soon as this candle, let's say one of these candles went below here and closed, I would be out, right? That's it. I'm done. I don't care where it goes from there. I stopped out. And my target is my previous high, right? So I'm not just picking random targets. I'm not picking a random stop loss. I'm basing it off of the chart. And this trade makes sense for me to take, right? Because I'm risking so little to make all this. And you guys can see exactly how that ended up turning out, right? So that was trade number 1 that I took. And we'll drop that. And then, yes, so this is another thing, right? So I like actually putting this little thing up right here, and you can do this on TradingView. I'm not sure if you can do this anywhere else, but this kind of helps me stay in my trades and hold them. But essentially, this is like, while it's in the green area, you know that your trade is still valid, right? There's no reason for you to sell it early or anything. Your trade is valid. And besides that, if you're using ICT concepts, it makes it that much easier, because not only do you have your stop down here below your fair value gap, which we can still bounce from, but you guys see that all these lows that we create, we are making structure right here. So this level, if you move it down a little bit, you see this is, if it dropped below here, this would be your structure break, right? On a shorter time frame, and you would have bearish structure once again. So you could keep your, after this nice move up, you can move your stop up to this area right here. So once you get a drop down, and if it breaks below here, you stop out, and you still preserve these gains from over here, right, from this move up. So that's number one. So you can move your stop up, you can take partials pretty much whenever you want, and you have your target set right there, and it's based on the chart. It's not some random target. So it kind of helps keep the emotion out of the actual trade. Now, right here is, I think this was on a higher time frame. Yeah. So this is a 5-minute fair value gap that was created right here. All right, we got structure break. So these were our highs right here. We got structure break right over it. Unfilled orders sitting right here. So you make a pullback right into this area. Now the exact same setup as the previous one, right? So your longs right there, stop loss directly below, and your target is your previous high, right? This is also almost a 4-to-1 risk to reward. So you see how this turns out for us too, right? You get a pullback and then a real nice push right up into your take profit area. Even this pullback here wouldn't have shaken me out, right? Because no structure break. And then it goes up and hits your target. And that was the last buying opportunity for that day. But yeah. So you guys getting a little bit of an idea of how, what should all go into actually planning your trade, why you should have your stop loss at a certain level. Now these, for me, these are considered higher probability setups, right? These are going to be trades that I can size up on, because look at how little you're risking to your potential reward. Right? So, yeah.
Hey, Key.
Yo.
Say that you set your risk reward zone, and then you buy somewhere, like we could say the red section, and you're expecting it to go up into the green. What if just, some freak news happened and you get one, super drill the earth red candle that blows all the way through? You haven't closed yet, but it looks pretty scary.
Right. I mean, so if there's something like that where you have that much momentum towards the downside, or like there's that much momentum heading straight towards your stop loss, then yeah, I would still stop out, even if there's no close below, because you're not gonna want, like, if there's some crazy news that comes out, right? You're not gonna want this candle to go all the way down here and then close for you to stop out. That just doesn't make sense. So you have to, you kind of have to adapt in situations like that. So when you see there's like some really high volume candles coming that are just coming straight towards your stop loss, I would have your mouse right on the market sell order, and I would get out as soon as it hits your stop loss. When there's that much momentum, whether it's news or whatever it may be, I would not hold that till a candle close, personally. That's just me. Worst comes to worst in a situation like that, if it wicks up, you can just buy again. Right?
Right. An example of that was that Facebook I don't know, that the fake news, like, I don't know, a couple weeks ago or something, just one super red candle in the middle of nowhere is like the most recent one I can think of.
Yeah, I think I know what you're talking about.
Oh, I think that was when the dude posted something on Twitter.
Yeah.
Yeah.
About earnings.
Yeah, so I mean, in a situation like that, I 100% I would still respect my stop loss whether a candle closes or not.
So in that case, because remember, we haven't set a hard stop loss because we are waiting for the thing to close. So where's the stop loss in that situation?
It would just be right under this fair value gap,
Okay.
right? So for this specific trade, now this is what I would be looking at. So this is an imbalance, right? You're imbalance. These are unfilled orders that are sitting here. You guys know how a fair value gap works, right? For the most part.
Yeah.
Okay, so then you know that once this gets filled, there's no longer an imbalance. These orders are filled and they couldn't hold it up. So there's no reason for me to stay in this trade now because these orders obviously were too weak to withhold the bearish pressure that was coming in. So in that case, I wouldn't hold on to this trade. Just based off the bearish momentum that was coming in. So it's just going to be in this general area right below. It depends on really how much you're willing to risk. This is about how low I'd go, and that's it. I would call it there. This would be my stop loss.
Hey, Key, sorry, bro, I got a question. But you know with the zero DT contracts, but they like the theta just kind of burns it out. Like if the trade's taking forever to go in your favor, so would you kind of just get out if your contracts are just not moving as much, or is the stock is just taking its time to push back up?
I mean, if it's really just taking that long, like I said, you can take partials, right? So if you have, let's say you have a full position, like 3/3 full position, I would start taking those partials. I would take a 1/3. I would take another 1/3. If it was really, really taking that long and theta was really coming down on me like that, at that point, I would de-risk. And that's usually what I do. I've done that before. You guys have seen me do that multiple times before. And then it ends up going like 100%, of course. But for the most part, if I see a trade like that where it's really taking its time or the theta is just too much on 0DTs, then I would just de-risk. So that way you secure most of your profits. And then at that point, it's kind of just you leave some runners to just do what they do. Even if those go negative 100%, I would still end the trade green, right? So that's kind of what you have to do in a situation like that. But yeah, that's a good question. That happens all the time, man.
Sure do.
Hey, Key, mechanically as well. So you're showing us the chart here on TradingView. So in real life, when you're planning out the trade, probably in TradingView, do you just have a separate screen with Thinkorswim or something like that to do your actual trading, or how do you mechanically go through the clicks?
Yeah, this is one monitor right here. I have another monitor to the right that you can't see, and then another monitor to the left that you also can't see, which I have two TradingView setups, and then my final monitor has my TOS setup and Webull.
Okay. And you're just using, the desktop to execute your trades.
Yeah.
And then monitoring the levels in TradingView. And then if something happens, you just react accordingly in Thinkorswim.
Yeah, exactly. So on Thinkorswim and Webull, they both have Active Trader for their web or computer platforms. So on Thinkorswim, obviously the big buttons there, it's all right there. You market buy or you limit buy, and then I have a market sell or a limit sell order, or those buttons are right there, right? So as soon as I enter a trade, and if I see this, if I enter right here, right, and boom, if I enter right here and I see this coming down towards my stop loss, immediately I would hover my button over the sell market so that I can get out in case it hits my stop. Because obviously, yeah, like you said earlier, we're not using hard stops, right?
Right.
So you have to be quick with it. So I have my mouse already hovering over the sell button in case I need to get out. And if it goes and triggers my stop loss, then I'm out. It's like that. Same thing with Weeble. Other than that, like once I see this green candle, then I'm not too worried about stopping out at that point. Then I'm just worried about taking partials, and even my partials are more based on technicals, right? So I would take a high like this. This is a little less pronounced, but these highs right here, these two, this one and then this one right here, these are a little less pronounced, but they're local highs nonetheless. So if I see a move up to this area, I would take out some, right? And you can see we kind of struggled around this area for a little bit, and then you get a nice little move up. Maybe you can take some more right there. You get a move down, still no break of structure, right? And then a move back up, and it breaks this bullish structure here, right? Maybe I'll take some right here, and then I'll take my final off right up here when we hit our final target. Same thing goes for here. I enter right here. This local high right here, these equal highs, these are a bit more pronounced. So when we make a move up to this area, I would take some off. Then you make a move up to these highs right here, I would take some off here. Right now I'm only in 1/3. Up here, I would take my final 1/3 off, and that's it. Right, leaving that final 1/3, like taking these partials, now allows me to hold this trade no matter what, right? Like even in this, because I'm now in a 1/3. Think about it, right? So once I take my partials over here and over here, I'm only in a 1/3 position. So when this big dump happens, I'm only in 1/3, so I could care less if that goes to 0. Right, because you can keep a stop loss at break even after you've scaled out 2/3 of your position, and so it doesn't matter to me if this even goes red. So I'll hold it. Right now, if I stayed in my full position, this is a little bit concerning. So this is where the emotion factor kind of starts to set in. You'll start to get a little worried, like, oh my god, I should just sell, or whatever the case might be. But having that 1/3 eliminates that, and then you make a move right back up, and it hits your target, and that's it.
Yo, Key, so a couple questions. Are you typically selling the market price, especially ZT, since it's moving so damn quick?
Most of the time, yeah.
And then could you go over structure break just really briefly as far as like what structure really is? I'm just a little confused.
Yeah, so structure. I mean, the simplest way to define structure and structure breaks. I go like a little deeper into this in my fair value gap video, but essentially you take local highs like this. So we can let me get rid of this. So we can agree here that this is a local high right here, right? And then we have another one right here. And then this is our final high up here, right?
Yep.
So you see why I drew these out, right? Off these wicks, and then these, and then this wick right here. This is our final wick up here. See that? And then for downside, there's this, right? Off that wick down there. And then you could do... I don't know, you could do something like this.
So you just kind of go candle by candle, like looking at...
So you're taking like these swing highs and swing lows. So this is a swing high, this is a swing high, this is a swing high. Anytime you break these, you're getting structure break to the upside, right? Now, if you break a swing low, right? If you break below this, then you start to build bear structure, right? And this is smaller time frame, so you have to kind of take that with... take it with a grain of salt, but higher time frame structure breaks is really what actually matters. But for scalping and for catching the smaller moves, which ICT is made for, catching the smaller moves, we go off these equal and local highs on smaller time frames. All of these is going to be structure, and then if you break over or under, that's what you call a structure break. So right here you have this low, right? Pretty pronounced. If we got a full break below here, we would have bear structure.
So that just changed the trend at that point.
Right, exactly. So once you have bear structure, now you look for a potential entry short, right? Vice versa, if you have bullish structure, you're looking for a pullback entry long.
Okay, bet.
Right.
Appreciate it.
Yes, sir. All right. I'll let Steele kind of get a little bit into his part about him identifying entries, and then we'll have like a Q&A towards the end. Mr. Steelarms. Let me text this guy.
What's good, guys? Steelarms here. Steelarms LLC, Stanway Investments. I'm gonna teach you guys entries and so Keith Flo did great job showing you guys how to identify different structures and targeting entries. You're managing a trade, and he showed his high confidence setups. Now we basically see almost the same thing in the market, but I like to go over my entries, my entry system, my the way I find setups. So I'm gonna share my screen here, and then I'm gonna go over with you guys. I didn't make a PowerPoint, but I want to show you guys how to identify high probability setups, how to wait for them, how to be able to spot them, and overall, um, just be able to take the trades and where do you mark your key levels, all that. So if you guys join the live stream, we're gonna get started. Everybody sees my screen, right? Everybody sees my screen.
Yeah.
Yep.
All right, cool. Okay. So before I go over, to understand trading, you have to understand market structure, right? You have to understand where the general direction's headed, right? That's the main key point about, being able to understand if price wants to go up and down, right? Because at the end of the day, we all have a certain bias that we go through the market with, but that bias has to be confirmed with structure breaks, with key level breaks, and understanding, where's the draw on liquidity in the markets. So the three setups that I really look for are fairly simple, right? And they all tie around key level. And I just Keyflow talked about ICT a little bit, and yes, I'm going to mention some of the ICT setups as well that I look at and incorporate in my trading. I'm going to show you guys the high confidence setups, the picture perfect format, and then we're going to hop on a chart and real quickly, I'm going to teach you guys how to spot these setups, how to identify them, how to play them with back tested results. So the first setup here is what I call here downtrend key level break, right? Downtrend key level break. So I understand a lot of people like playing downtrend or uptrend breaks, but they do it incorrectly, right? They're not really understanding the main concept of it. They rely too much on the downtrend rather than the key level. So when price is in a downtrend, it's creating lower lows and lower highs, right? As you guys can see, it's clear market structure. Nothing is hindsight. You have to see the setup to play the setup, right? This is not, you got to wait for it to form out and then you can identify the setup. So here, I understand there's the key level, right? That's the key level. What To play the downtrend breakout correctly, you have to wait for market structure shift. What a market structure shift is, a downtrend is identified by lower lows and lower highs. A shift in market structure would be a lower high gets breaking out, right? That means there were enough strong buyers to push the price above prior highs and change the market structure, right? So we wait, we don't take the trade on the downtrend break, right? How many guys, like I'm sure a lot of you guys took the downtrend break and then it ended up not working out, right? And then all you did was keep adjusting your downtrend. You kept moving it up. You kept moving it up. You kept moving. Oh, this is wrong. This is wrong. And then it says it messes up your setup. Main key level here is downtrend. Your entry is a close above 2954.25. So your prior high, right? And so you play this setup. Your entry will be here and you would target these next highs, right? You would target these next highs. If price starts breaking down, also another setup would just be, a rejection and bounce, right? But I'm a breakout trader. I really look for breakout trading. Here, playing the downside also involves breakout trading, but I'm not going to go too deep into that. It still involves the same setups because from price to get here to here, it creates an uptrend and it breaks that uptrend for it to drop lower. I'm going to discuss those setups, but I'm going to discuss a channel breakout rather than, just bouncing between a zone. This would be a high confidence setup for a downtrend key level break, right? What's my next setup? My next setup here is uptrend key level break, right? So when price creates an uptrend, it creates what? Higher highs and higher lows, right? Higher highs, higher lows, higher highs, higher lows. Now, let's say you want to play the breakdown of this setup, right? You want to play the breakdown. How would you play the breakdown? You wouldn't automatically just take the breakdown trade. Like if uptrend breaks and you take puts, chances are you're mostly going to get stopped out, right? I'm going to go over an example and I'll show you guys why you'll get stopped out. But the uptrend key level break, I see the prior higher low. I want to break that prior higher low, possibly retest it, and then I target these next higher lows, right? So right here is a market structure shift, and then you target these lows, right? These are very easy to spot, very, very easy to spot. Next setup here is my consolidation zone breakout and break and retest. Here, so you have a consolidation zone. Right? That means price is neither making higher low highs or higher lows. It's just going sideways, right? All you're waiting on is a break to the upside, right? Or downside. And this is the consolidation key level breakout. Fairly simple setup. None of these setups are difficult to understand. And you guys are probably wondering, like, where's the wedges? Where's the triangles and shit? In essence, all of this ties into that because what creates a triangle? An uptrend and a downtrend, right? So you have this uptrend and a downtrend, right? So either breakout would go right back to this setup here. How would you play it? Right? It would be the same thing as, it's all about market structure. There's still market structure here, right? Either these highs get taken out or these lows get taken out, and you can target these lows and highs, right? So on and so forth. So I don't really like go over that setup in the sense of, oh, it's a major. I'm mainly looking at downtrend key level, uptrend key level, and consolidation breakout. Now, if you look at the market as a whole, it's really doing all of that, right? It's just various shifts in market structure. Let's understand the price action here. This is a perfect example of what I just showed you guys. Here, what you have is price in a downtrend, right? You see this setup. This is not a hindsight setup. You have to see this. Let me bring this back here so you guys. This is what you'd be looking at before the breakout. You'd have to see the setup to play the setup, right? You can't miss it. It's on a daily, high time frame, high probability, right? So you can't really, it's there, right? You see this down channel. Now, what's your entry mechanism, right? What's our setup, right? So what do we target? We target our breakout above the prior lower high. Price in a downtrend, we target the lower high. We see here that price has a lower high here, rejected the downtrend, drops, that's a lower high. Where's our next targets? The next lower highs right here. You just go up and you target these individually, right? Now, when you go in, right, all I'm looking for is an entry, like you can follow any entry mechanism you want. The main point is that this key level broke out, right? You guys can have ICT breakout setups or anything really, right? All you're looking for is a candle close above this key level, right? And so when we see that price pushed up till here, obviously you could take trades this bounce right here. There's a lot of setups down here you could take as well. But if you want to be a disciplined trader across the board and you're trading multiple different setups, right? If you're trading SPY daily, you might want to, shift on lower time frame scalping, day trading, and all that. But these are setups you consistently see across the board, right? So when price is near our level, right? What I like to do is hop on the 15-minute chart and then wait for candles to close above the level right here, right? We see that candles close above the 15-minute candle close above the level. Now this is a high probability setup, right? Because our stop loss will be right below our key level. And where's our target? These highs over here. And then what occurs is that price just this is futures, so the movement is going to be a lot like this is like after hours, right? So I'm just going to go on a higher time frame so we can skip forward. Right, retest it as you guys can see, and there's a fair value gap over here on a lower time frame right here, right? So price broke out of the equal high structure. I know Keyflow really likes these setups where, you know, price breaks out of equal highs, creates a fair value gap. Right, this is a massive imbalance. Comes fill it right here. So this is, and then this is your entry, right? And you target these next highs as mentioned, right? High probability setup. And look, you target that high. So if that high breaks out, what do you target next? The next possible highs, right? Pulls back to the levels, pushes up, right? Fairly simple setup, very easy to understand. Very easy. So now you have a general bias. You understand where the market's going. The key to trading is to understand where price is relative to the chart. People trade with blind, like they're blindly trading because you don't understand where price is relative to your chart, right? If you don't understand, if you're taking like you know, just buying whenever someone says buy, selling whenever someone says sell, and you don't understand, like you might take an L in the trade, even though that person might take a W because he understands where price is relative to the chart. He has a clear risk to reward, and you don't know if it's gonna where it's gonna push. So having a general understanding of where price is relative to the chart allows you to you know, be able to confirm your bias, right? Once I see strong push here, these structures completely breaking here. This is a money setup. These are setups you can size into. This is where SPY had back to back to back green days. And these setups are fairly common. Look, right here. Look at this dump here, right? What is this setup here? It's an uptrend key level break. This was a downtrend key level break. This is an uptrend key level break, right? So we have this up channel right here. I'm not really focused on this resistance up here. What I'm really looking at here is where's my key level? My key level is this higher low here. Again, this is not a hindsight setup. Why? Because this is the structure we're looking at before we play this setup. I'm not determining the setup. So over here, right? Let's say price is over here. I'd have the same setup, right? It'll be the same similar exact setup. Okay, if price breaks this key level, I can target these lows here. But it didn't. Price bounced off the level, and I played the upside, right? So it's fairly simple to switch your stance on these, right? So now price tried to bounce off this level again. So now we go for the obvious higher low, obvious higher low. And then on the breakdown, we're looking to target these next levels. All right. Now I wonder, I'm sure a lot of you guys are asking like, oh, is it only in higher time frames, lower time? I'll show you guys, this is higher time frame trading, and I'll show you guys intraday trading. So you could intra-trade these levels. You're as a trader, as a novice trader, you're probably not going to swing far out. You're not going to, to hold this entire move. You're not expecting this entire move because, it's nerve-wracking, right? But you're not going to hold this entire move. You're probably just going to scalp it from, 10, 20, $30 scalps on ES here. But it's just to confirm your general bias, right? So once price broke, right? You can look for fair value gaps on that level break, but the main thing here that occurred was key level broke, pulls back to levels, consolidates, and you can adjust these levels over time, right? You can start adjusting these levels, right? So you can get a sharper entries and all that, right? But you still understand that these are structures breaking, right? And then what we see here is this dump here. I'm not going to go over the full entry mechanism on on ES because I'm not trying to deal with after hours. It's going to mess up the thing. So I'll show you guys the secret sauce for entry mechanisms, and how to really enter a trade and hold a trade. So I'm going to teach you guys basically the secret sauce real quick. So this is what I call the 5-6 candle Steelarms strategy, right? I got to put my name on there because I can't have people stealing it. So this is the 5-6 candle strategy. Now we're going to shift a little bit towards intraday trading. Here on BA, right? Let me show you guys. We call this setup, actually did play this. A lot of the setups that I'm going to pull up, I played these setups. I remember them where they are on the chart. So here we have BA. What setup was this? This is a classic bear flag. So what does that mean? Uptrend key level break. Right? So here, what you have is this bear flag. Simple. Now what you're looking for is what your obvious, this is an uptrend key level break. So you're looking for your obvious higher low to break. Where's your obvious higher low? Right here, and right here. Right? And so all you're looking for here now is 15-minute candle close below level. Here bounced a little bit. I don't when key level breaks, I don't want it to be a green candle. Like for the downside, I don't want it to be a green candle. I want it strict to be red candle. So I'm looking for a 15-minute close below my level. Not getting it. What I'm going to do is actually adjust it here, right? But overall, you see that this key level ended up breaking here, cracked right there. Now, but I want to adjust this to take that out. 15-minute close below my level. I enter the trade. Stop loss above that candle or above your 580 MAs. So this is the overextended setup. So you'd probably wait on a pullback, but the setup is there still. Your target's these lows. But what I do here is play 5 to 6 candles. So after you might take a trade, your emotions are, rampant, right? You're going to be excited. You're going to be nervous. You're going to be anxious. What the rule here does is to eliminate all that. Simply, you wait 5 to 6 candles before you make any form of decisions after the breakout candle. So 1, 2, 3, 4, 5, 6. I'm out of the trade because it already hit my target. Now I can decide if I want to leave some or completely exit the trade. Price hit my target. I'm out of the trade, right? After the 6 candle, what does it do? It dumps more. Doesn't matter. You sold where you needed to sell, right? All this other move is, it's just, oh, I missed it. Oh, I did this, right? It's just going to make you feel more anxious. It's not going to make you feel better. Here, if the market was dumping more, you could have just, solved more partials and left small runners. And then on the next 15-minute candle close below level, you could have added again on this candle. So 15-minute close below this level, you can wait another 5, 6 candles. One, right here. I don't think you guys can see my cursor. Let me put it here. So after this candle close below level, you hold 5, 6 candles. 1, 2, 3, 4, 5, 6. You sold the bottom basically on these, and then price decided to bounce, right? So that's the 5, 6 candle strategy of holding a trade. Let me show you guys another example of how you can play it. Let's see. Pfizer here on Friday, right? Pfizer here on Friday that we took, right? 5, 6 candle strategy. Let's identify the setup here. What's the setup? What's the setup on Pfizer? Remove your EMAs, remove whatever EMA cross you guys have, MACD crosses and shit. Remove all that. Here, understand structure. Uptrend broke. We're looking for a key level break, right? And this key level was breaking, right? This was June 17th, so let me go back. So this was Friday's action. What's my setup here? Uptrend, key level break. Where do I target? Next lows. I low-key want to target that because it's more of a zone than anything else, right? This area is more of a zone. So now what do? I usually pair the 15-minute with 1 hour, but I have the 15-minute here. January 17th, Friday opens up. All of my setup here is I'm strictly looking for downside today. I'm not really interested in playing upside. 15-minute close below my level. What do? Enter the trade. Candle stop loss above that candle. First target would be here, this low, and the next target would be here. But I'm strictly gonna follow 5, 6 candle strategy for my targets. 1, 2, 3, 4, 5, 6. 6 candles, right? Trade played out. I'm out of the trade. What happens next? I don't care. Bounces and all that. That's the 5, 6 candles entry mechanism. I don't want to take too long and break down the intricacies of it, but that's the main setup I'm looking for.
Here, real quick, I want to add too. You guys look at the risk circle because Steel also put up the long position, short position thing on TradingView. You guys can see the risk reward on both of the trades that he just showed you guys. Look how it makes sense, right? Look how little you're risking to what your reward is. It's at least a 3 to 1 on both of the trades that he just showed. So I just want to point that out real quick.
These are your high probability setups. When you guys get excited and guys, Learn, if you're a novice trader, stop playing zero DTs, right? Until you get experience, like Keyflow can enter like sharp entries, right? He can execute like pretty fast, right? And if you're a novice trader, you might not be able to do that. And so you don't understand the emotions that are involved with zero DTEs, right? So all you're gonna do is just blow your account, right? It's really simple. Like you're not letting time for your trade play out. This is 5-6 candles. That means you're waiting at least from 9:45 to 11 to 11:30, 12 for your trade to complete, right? And if you're playing zero DTEs, you're not gonna have the emotional IQ or just like understanding that it's gonna take like at least an hour, 2 hours to play out. You're not gonna let it play out. You're gonna like you see this green candle forming, red candle forming. You're just gonna get too excited. You're just gonna like not execute the trade. So what you got to do here is once you take your setup, put alerts at your stop loss and halfway through the take profit and the full take profit and leave it. Walk away from the trade and then come back only when your alerts get hit. So now you're not even looking at the chart. Don't look at your P&L. Let the trade play out. If you get stopped out, you'll get an alert and you'll get out. This will avoid you because if price can pull back here, right? Price can pull back here and just play around here a little bit before it dumps, right? Typically, I usually get out once a candle closes above my levels and all that. But our stop loss is right above that candle. Price never. This is zero drawdown play. Retest, so you can add them more on the retest. 5-6 candles, dump. You're out of the trade. Doesn't matter if it dumps more. Who cares, right? These are fairly here. I'm gonna go over one more setup. U.S. oil, right? The setup was money. Right here, it was more of a scalp. So this is intraday trading, right? Here, the setup here was there on the 1 hour. Here, let me go back here. I took these all in real time. I could send you guys my execution and all that. But right here, you have this is basically like recent highs, right? Price is shifting structure here. Look what it did. It already broke structure, right? These higher lows, price took that out. Now it's creating, it's more of a bear structure than anything, right? Because it already took that, it wants to go lower. Fill the gap up here, right? So gap fill and dump basically. All I'm looking for here is a candle close below this level and mainly this level, right? So below that level, I'm looking to enter. Price came right here, right? I'm looking for a candle close below that level right here. Either you could have taken off that. That was around 1 p.m. I wasn't really watching this setup. At 1 p.m., this was my recent higher low, obvious higher low, right? Let's see. Let's wait for a candle close. All right, bang. So what do? You take the trade, stop loss above that high, and you target these lows. This is the 1.58 to basically 1 to 1.58 risk to reward. It's not bad, but if you're intraday trading, perfect setup. This is a wonderful setup, right? Your stop loss could just be right above that high. Yeah, basically 1 to 2 risk to reward. And then 5-6 candle strategy. 1, 2, 3, 4, 5, 6. Right? Here, by the time your target got hit, you get out of the trade. You don't really wait for the fifth and sixth candle anymore because your target already got hit. Bang! You caught a nice setup. This went pretty nicely. And then let's look at the main setup here. What's the main setup? This is a consolidation zone breakdown, right? This is a consolidation breakdown waiting to happen. Where are your targets? Your target are these highs, these lows, excuse me, right? And obviously this 82 psych level and a breakout level. So this is a high probability swing, right? Now you're getting into swing trading, right? You're able to understand how to properly analyze swings. Look, 1 hour closing below level, that's a big sign. Let's wait for the close right here. 1 hour close below level. Okay, right there. Bang. 1 hour close below level. And look, it's pulled in back right here. This was your money setup. So you took the dump from one key level to the next, one key level to the next, pulls back. This is a pure example of structure forming for more bearish setup. Price is making a lower high. had this dump, and this is from a premium to discount move. What does it do? And then, if you really got the secret sauce, you pop out the Fibonacci retracement made by me, and it will give you the target right here. The golden zone's the target, and you hold it to that level, bang, you get out. Every single time. I'm not going to discuss that yet. That's for another time, but that's how I set my price targets. Works fairly accurately, highly accurately. Like all of these moves could have been predicted by that, but price came to your target, you sold. These are the setups you want to look for. These are the setups you size in. If you're, small account trading, if you're, trying to size up your accounts, size in on the right plays. Don't just get excited because you see someone on Twitter popping out zero DTs and then, losing it sometimes, then making it. It's difficult, right? Zero DTs are fairly difficult, and it ruins your trading if you're not doing it right, right? It ruins your trading because you stop waiting. You stop waiting for your setup to play out. It's too much emotions. It's not. It just doesn't make sense, right? I think the zero DTs were basically made to make people lose money, right? So understand the high probability setup and take those high probability setups. If you guys have any questions, I'll be able to answer. Uh, what's it called? I'll be able to answer any questions if you guys have any regarding my setups, any entries.
Yo, so does the 5-6 rule work for any strategy or no?
I don't know about any strategy, but it works on the 15-minute time frame mostly. Because the reason behind the 5-6 candle strategy is because you're not going to take a trade at 9:30 sharp, right? You're probably going to wait till 45, 9:45, or even 10, right? After that, what's going to happen is the majority of successful breakouts are from 9:30 or like 9:45 until 11:30, right? So what this 5-6 candle structure makes you do, this 5-6 candle strategy makes you do is hold your breakout when it's high breakout time, right? It's high probability breakout times, right? There's most volume right there. London and New York sessions are mixing, so these trades are going to go your favor more often than not when the market's trending and has high volume. So you catch the bigger move. That's the reason behind it. I don't know about like the 2 minutes, the 3 minutes. Because keep in mind, if you're going to do the 5-6 candle strategy on the 2-3 minutes, the 5-6 candle strategy is on the 15 minutes. So you probably have to wait 3 times more candles, right? So you can also, depending on your scalping strategy, you can play the 5-6 candle movement, right? Like for example, if you're trading ICT here, right? Like Friday was a perfect example of ICT trade, right? Right here. This was Friday's action. Let me break this down how ICT would break this down. What occurred here on Friday is price is in this range right here, right? In a sense, it's in this range. And you have buy side liquidity above this level and this level. One thing, there's 2-3 different ways price could do this. Price could take out buy side liquidity here, reject and dump, and take out attack sell side. Or it could break out and take out buy side over this level, right, above this level before rejecting and dumping. What did it do early on before 9:30? Let's see. Price heavily attacked sell side, right? It shifted market structure here. Price shifted market structure. What did it do? Pull back to the fair value gap over here. Now this is all on the 15 minute, all on the 15 minute. Rejected. So now you take your setup, stop loss right above that high, target right to this level. This is a 5-1, 1-5 risk to reward, right? You can use the 5-6 candle strategy here. You can do whatever you want, right? But basically, it's on the 15 minutes, so I'm going to use the 5-6 candle strategy, and I'll go on the 2 minute, and you see how many candles that is, right? 1, 2, 3, 4, right? By the fourth candle, it already hit your target, so you're probably out. You're not going to wait 5-6 candles anymore. On the 2 minute, right? You see how it's like a larger, right? So I don't know, depending on your time frame, whatever you use, set your levels, and then because the levels I set and the 15 minute just works out with 5-6 candles. I've studied this over 100 setups, right? But just study your setup and see how many candles it takes for it to play out,
For
right?
sure.
Like from here to here, right? Like what you should be recording down is how many candles did it play until the next low. All right, what was how many candles did it play to the next low, right? Record these, right? Journal these, understand them, right? How far was the low and how far did it drop? Hope that explains it. Next question, if you guys have it.
Any questions like overall, whether it's what I went over or steel, like anything at all?
I guess this can be regarded to either of you, whoever wants to answer. But so I just kind of want to master one stock, obviously, just because I'm beginning. So when I'm looking at SPY, I was watching one of your videos, Key, and you said that I don't even have to look at SPY at all. I don't know if your views have changed on that, and I can just still look at ES when I'm taking plays. But I don't know how is the way to go about that.
What, like whether to look at ES or SPY?
Yeah, so I was watching one of your just one of the older class recaps, and you were saying that you didn't even have to look at SPY at all. You could just look at ES to take plays on SPY.
Yeah, yeah. I mean, I most of the time I do. I do look at ES over SPY because of the overnight session, and it's mainly just because of the overnight session. Because in the intraday session, they're both the same thing, but obviously SPY doesn't have an entire overnight session like the one that you see on Steel's screen right now. You have a full overnight set. Like right now, futures are open, right? So you can see the overnight session. You can see what's going on. SPY doesn't have that. So the main reason why I watch ES over SPY is for that reason, because then you can analyze this overnight session and grab sell side liquidity and buy side liquidity and whatnot, and like market structures. Like you can grab all this stuff from your futures overnight session and be able to implement this to trade SPY contracts instead. And same thing with NQ and QQQ, right? Same thing applies. But yeah, I prefer to use futures charts to trade QQQ and SPY.
Just a little more accurate with some more time.
Yeah.
Um, as far as the buy and sell liquidity, is that just? I'm a little confused by that. Obviously, it's just when people are selling, and there's just when there's more selling pressure and more buying pressure in certain areas.
Yeah, well, Steele, you want to explain it? Because you have your screen up, so you could explain liquidity and
Yeah.
liquidity grabs.
All right. So people don't. So people are confused with the word buy side liquidity and sell side liquidity. So can you explain your question one more time again so I can fully answer it?
Yeah, my bad. Basically, just what it is, like
Okay.
to identify it, and I guess just like the definition of it and how to like
Cool.
take it on a chart.
I got. All right. Bet. So, right. I'm gonna tie this to people who think they're breakout specialists. How to really understand liquidity, what it is. When price is pushing higher and creating structure, right? There's gonna be two players in this structure format, right? I'm gonna actually draw it out so you guys can see, and then we'll go to the chart. It's gonna be a quick explanation. So when price is making higher lows and higher highs, there's two form of traders at here, right? At this level. Let's just say price bounces up this level. There's buyers and there's sellers. Buyers in the form of someone went long here and is targeting new highs. Stop loss right below that key level, higher low. And there's the other trader here is a seller. So he's a breakout trader, right? He's waiting on this channel to break out. And his right here, his entry is right here, stop loss right above that level, downside. What the market wants to do here, let's say it wants to trend higher. Let's say it wants to do anything. What it can do here is stop out the buyer, right?
Mm-hmm.
And then please the seller, right? And just dump lower. Another thing you can do is, right, attack liquidity. If they want to take out liquidity, right, what they do here is break down, stopping out the buyer, and then pushing up higher, stopping out the seller. This is considered sell side liquidity because the seller gets stopped out. So the ones that think they're breakout specialists, they get stopped out, right? Because the key, in essence, your key level broke, you have to enter the trade. They get stopped out, right?
Is that why you wait for a close below or a close above?
It's exactly what you wait for the close below, close below. Right here, look. This is look what happened here. Price pushed lower, sellers get stopped out, right? They think the breakout specialist on 1 minute charts trying to take the puts, but they get stopped out right away and price pushes up higher,
Mm-hmm. So
right?
basically, it's just the key levels that where buyers and sellers are
Yeah.
just like
And
balanced.
here, for example, here, right? price is taking out, right? It's pushing lower, taking out these sellers.
Mm-hmm.
But if it wants to push lower, what is it going to do? It wants to come take out buyers as well. There's buy side liquidity above this level, but there's more buy side liquidity above this level.
Yeah.
But it comes here, it stops them out, and it stops out the people who are already short, in this move. It comes and stops them out, and it also takes out buyers because it stops them out as well because they think it's a breakout, and then it dumps lower, does the exact same thing, right?
Mm-hmm.
That's all it is. All it is, right? Like for example, just understand where buyers and sellers could be. Where could the average trader be? Where could stop losses be? Where could price attack before pushing towards the new level? Just keep those in mind.
For sure. I appreciate it, bro.
Mm-hmm. Hope that answered the question.
Think about like retail, like because the average retail trader, they all think the same way, right? So they're all going to, most of the time they're all going to have their stop losses placed at the same level. They're going to be buying and selling at the same level. So like think about where you would place a stop loss if you went long, or where you would place your stop loss if you went short, right? And that's more than likely that's where liquidity is, because other people are going to have their stop losses at the same level.
For sure. Bet.
So the whole objective is to identify liquidity and then either buy or sell liquidity instead of becoming liquidity.
Makes sense.
But yeah, bro, that's all the time I have for right now. I really appreciate you hosting me, bro. I'm gonna host you on Tuesday. We're gonna discuss some more ICT and fair value gaps on the Smology.
That for sure, man. Thanks for coming on. I appreciate
For sure,
you.
bro. Guys,
Yo,
also post
Steelarms.
cards. What's good?
Bro, that was such a great example. Bro. I really appreciate that. Like, I
For sure.
finally fucking understand like what the fuck that shit is.
Yeah, bro, no problem, bro. Hope you guys learn. I post these setups all over my Twitter, guys. So go and if you guys want to check it out, go ahead. It's at Steelarms_, right? Just type in Steelarms_. I post these setups. I teach these setups. I try to make trading as simple as possible for the average trader, right? Just so you guys can understand, like there's multiple different ways you could have traded this setup, right? It could have been the 5-6 candle strategy, or this really wouldn't have fit here because you wouldn't be able to catch this. This was a different time frame, but this is like prior to market open. But a lot of these setups are just everywhere. You guys can see it. Very simple, very easy to look at. Make sure your charts are clear, guys. So that's very important. Don't litter it with I don't know, like just too many lines and levels, right? Keep your levels concise and clear.
Appreciate it,
But
man.
that's all I got to say, man. Kifo did an amazing job, man, teaching you guys the fair value gaps in ICT. So make sure you guys rewatch this video, guys. I think this was a really good session. So make sure you guys watch this again before Tuesday. So I think it'll definitely help you guys out a lot.
For sure.
All right, bro. I'm gonna head out, man. Take care. I'll catch you guys later.
All right. Peace out, man.
Good night, man. Good night.
All right. So somebody asked, what's the best time frame to chart the channels and key levels for intraday? 1 hour, 4 hour, or daily? For intraday, I would do 1 hour would be the highest I would go for intraday. Because your daily levels, look, let me show you guys. So, boom. All right, so your daily levels are going to be like, they're going to be pretty spacey, right? So like maybe this is a daily level, right? Maybe this is a daily level up here, and then like this is a daily level. I don't know, I'm kind of just making shit up, right? I'm just trying to show you guys how this would actually work. So let's say these are your daily levels, right? I don't really see much within besides maybe like this or something. But when you go down to intraday time frames, like a 15-minute, you can't really like look how far apart they are, right? This isn't going to do much for you. You're not going to be able to trade every day based off these levels. So what I would do is, in addition to your daily levels that you already have, I would go down to an hourly, right? For your intraday levels, I would go down to an hourly. Right now you see that you have a level right here, right? Obviously this gap fill, this is going to be a level. And then up here, this high corresponds with these lows over here, right? These are going to be your levels. Down here, look at this low right here. right? And then right there, that might be a level. Now, if we drop down to a 15-minute, you can do something with this, right? Now you can do something. This is a little less spacey. So I would go 1 hour would be the highest, and then I would start dropping down from 1 hour and go like 30-minute. In the 30-minute, you might find some more, or you might be able to adjust your levels, right? So I can readjust that. I'll keep that one. I'll keep this, yeah. And then you can go down to 15 and see if you find some more. Chances are, if you got your levels correctly, they're all going to correspond with the time frames, the lower time frames as well. So right there, you just found one on a 15, right? I wouldn't go any lower than a 15. That's me personally, but you can go down to a 5 as well if you really need to. But 15, 30, and 1 hour for your intraday key levels.
So more than likely, because of time frame continuity, would it be good to just chart the 1 hour levels just because they're more respected?
Yeah, 100%. Your 1 hour levels are going to be way more like all your higher time frame levels are going to be 100% way more prominent than something that you might find on a 15 or anything lower. That's just how key levels work. And yeah, time frame continuity is a concept that you can throw in there as well, because if you're trading with time frame continuity, more often than not, these higher time frame levels that you have are going to go hit.
For sure. And then I just feel like every time I go and try to chart, it always just becomes super messy because I'm trying to do so many levels. So how many would you recommend doing? I know you probably don't have a certain number, but like, would you recommend just doing a couple on each time frame?
Yeah. I would go. I mean, if you see that there's like too much clutter, I would go like get your daily levels, get your hourly, whatever, get your levels from all your time frames, and then do like a process of elimination. So find your strongest levels that you see are getting respected the most. So maybe they're getting a lot of rejections off a certain level, or you're getting a lot of bounces off a certain level, right? Those are your levels you might want to keep, and then take out those levels that you see that aren't being respected as much. They're just getting sliced right through, like they don't even exist. Those levels, those are the ones you're going to want to get rid of if you want less clutter on your chart. Me personally, I usually have my charts kind of look like this, right? I would have levels like this. So I would have my main levels that I get from a larger time frame, whether that's a daily, weekly, or whatever. And then for the day, every single day, if I see a level that's being respected a lot, right? So for example, this, I would keep that. And I would keep this lower one, right? Maybe I want to get rid of this one, right? Or maybe I want to get rid of this one, right? And I would keep these and put them over to the next day, right? Next day, like one of these invalidates, I'll delete that, and then I'll make a new one, because there's new ones that form every single day, right? There's new levels that form every single day. I know a lot of people, they start every single day with a clean slate, so it'll look like a brand new chart every single day, and they'll put out new levels every single day. You can do that too, right? It's really just personal preference, what you want. If you get them right, they're going to work just as well. So that's why ideally you want to get your levels right the first time around, so you don't have to go around fixing it later after you find out that it's barely being respected.
So do you still use the ES 12-hour strategy for as far as seeing what your bias is going to be going into the day?
Yeah, absolutely. So you see,
it's still a one candle, right? On today's.
yeah, still one candle, because this candle that's forming right now is going to be your overnight session, and then the candle that forms tomorrow morning at 6 a.m. Eastern is going to be your intraday candle.
Yeah.
So if this candle closes the way it looks right now, right, you'd be playing a break below here or a break above here. And as soon as one of those trigger, you have full time frame continuity downside already. So, you can play that. Once you get a break above here, you'll get time frame continuity to the upside. Your weekly, I think, we're going to start a new week too, actually. So, yeah.
Key, this is kind of off topic, but is there a specific reason you went long on SPY, like on Friday?
Like my swing.
Yeah,
Yeah. Let me show you.
I know we're way too overextended. We got so many gaps that we need to fill.
This is why I went long. So we have this broadening formation here, and to me, this looks more like a bottoming setup than something that wants to continue down. Also, you know, kind of throw in the fact that we have 1, 2, 3, 4, 5, 6 days down, and they're all gapping down. You know, I'm expecting somewhat of a relief bounce. You know, if you go down to a smaller time frame, like a 1 hour, maybe even, this kind of looks like something that's starting to bottom out a little bit, right? As for a swing, for a 2 week out swing, I still have a tight stop loss with below this this level here, 362.22. This low. This is going to be my stop, right? Below that, I'll be fully stopped out. But you know, the reward here is too good for me to not take, for something that I feel like might be bottoming out. Like my stop would be right here, and then my minimum reward would be this high up here, right? That's a 1 to 1.3 right there, and then up here, which is going to be a 1 to 5, and then up here at the gap fill, and then look, we have like an unlimited amount of gaps up here. Personally, I'm looking at the crypto markets as well, because our market's kind of tracking crypto, and crypto's tracking ours. So crypto markets are also starting to show signs of a temporary bottom, but I'm net short, of course. I'm gonna short this thing till fucking 200s if it goes there, but I think we see one more leg up, and ideally I would like to see at least 390. We might even see 400s, but I think we get one last leg up before a leg down, because you have to understand liquidity grabs, right? You can't just dump and just keep dumping, right? In stocks go, look, they don't go like this. They don't just keep going down, right? They go down, up, down, up, down, right? So there has to be some type, and every single one of these moves up is a liquidity grab, right? Because in order to go lower, we need to take out buy stops to the upside, and then, you know, we go lower. There has to be some type of liquidity that's being grabbed. So, you know, market makers and institutions, you know, they're not going to short this low because this isn't ideal, right? They want cheaper prices. You know what I mean? So they're going to wait for a leg higher, or they're going to make this go higher, and they're going to take out buy side liquidity, and then they're going to load up on their shorts there when they're dumb cheap, and then they're just going to short it. That's my personal opinion. I just think we have. I may have even timed it wrong, but I still think that we see a leg higher before a leg lower. That's just me.
Average down a little bit for this.
Yeah. I mean, and me personally, I'm probably just gonna stick to my stop loss. The risk to reward there makes more sense for me, because honestly, once we break below here, our monthly demand is down here at 330s, right? This is our next stop. If we break below 360, we're going down to 330s, and that's 100%. That's where monthly demand is, right? Check that out. And then once we break below 320, then we really don't have a true demand on a monthly. But if you go down to a weekly, dude, our next demand is down at 240. So this has so much room lower, and the ideal target here would be COVID lows. That's my target, is 218 for this big drawdown. And I'm super surprised that we're already at 360, because I was expecting this recession or this dump to take at least another year or two, and it still might, but I think overall, we've had this huge red week, and we have to take some type of buy stops out to see lower.
I feel like we're oversold. I feel like the worst is yet to come, to be honest.
Yeah,
But
I mean, from here, I'm expecting at a minimum another 20% drawdown across all the entire S&P, at least another 20%. But you know, the whole oversold, overbought bullshit, it's more noise to me, because that, you know, like the RSI, MACD, all this shit, I've done it like multiple times where I used to use RSI and MACD, and I've seen RSI bottomed out for like weeks, and I've seen RSI topped out for weeks, and I've seen MACD cross and it doesn't do anything, right? So that's why I kind of eliminated those, because it's all just more noise to me. But you have to look at it from a different perspective. Instead of oversold and overbought, you have to realize that in order for a move up or a move down to continue, there has to be liquidity taken out from one side or the other. And for that to happen, we're going to need to see a move back to the upside here, take out liquidity, and then go back down. Right? Even like a target over here could also be like 384 up here. Right? We make a move up, right back into this gap. Right? We're going to take out buy stops. We're going to take out sell stops and then come right back down.
my last question, because I gotta get to bed, bro. But if I was playing EMA, is it a 5 minute close below for stops, or 15 minute close
15.
below? 15.
Yeah. We don't use EMAs on 5. I use EMAs on 15, 30, and 1 hour for intraday. And the reason I teach you guys all these different strategies, and the reason why there's a fucking massive ass education section down here, isn't for you to like use everything all at once. Like me personally, I use like a little bit of everything for more confluence, but it's there for you guys to see what works best for you and then implement that. So me personally, like the strategies and the setups that have made me the most money, I'll be honest, is EMAs and the strat. So I'll use like a combination of both, right? So if like I'm on a 15 minute right here and I pull these up, I would look for some type of strat setup happening that's right at the EMAs that I can buy or sell. Right, so this is a good example here. Check this out. So this is a 2-2 reversal happening on a 15 minute, right? A potential 2-2 reversal happening. So your trigger is right here, and your target is up here. Let me get rid of this. So once you have these two, right, and you have EMAs that are stacked right here. So I'm expecting, okay, this 2-2 up is going to fail right at the EMAs, and then a 2-2 down is going to complete. And it ended up happening. It was a little choppy through here, but you guys see that we rejected this candle rejects right at the EMAs, right? We make a move down, we trigger the 2-2 down, and then we trigger another low. It doesn't quite get to this low, which is our 2-2 down trigger, until all the way here. But you guys get the concept here is we're using both of these two strategies, the strat and our EMAs, in confluence. So this is going to lead to a higher conviction trade for me, right? And whereas if I only have EMAs here, I would be like I wouldn't have that high of conviction taking something like that. Whereas if I had like 2 or 3 different strategies that I use and everything pointed to the same answer, I'm gonna have way more conviction in that, right? Like think of it this way: like you're taking a test and you have an answer, right? You might not be too sure about it, and so you go and you ask your friends and they all have the same answer. Now are you more sure about that answer, or would you have been like better off you just having your own answer, not asking anybody else, being unsure of your answer, and handing that test in? Right, think of it that way. So it's multiple things that I use that have that confluence factor, which then gives me more conviction in all the trades that I take.
For sure. I appreciate it, man.
No problem, man. So he said, last week I played the 150p for 624 in meta, 172 daily bounce based on these monthly demand zones. Do you think this is a good setup, or did I miss something? Yeah, it could be a good setup. Yeah, I can't say no because I'm also long, but this, like all these swings that I'm taking, these long swings, anytime I play longs, for now, since we have full time frame continuity down, we have to understand everything is red. The monthly is red, the weekly is red, daily is red, everything is red. So, on a red day, you can still play long, right? On a red week, you can still play long. On a red month, you can still play long. You still, at the end of the day, you have to analyze these longs. So I took a swing long, but it's light. And anytime I scalp longs, it's light because I'm going against time frame continuity. So it's a lower probability trade than if I was to take short or play shorts. That's going to be higher probability for me.
Hey, yo, still, bro. I mean, Keith, my bad. Quick question. If you're trading one con, do you still
Hey,
like you
he,
can't
I think Steelarms mentioned earlier in his discussion that he waits until like 9:30, and then you're gonna get good setups because you still have volume from Europe or something like that. Can you just talk about that just a little bit?
Yeah. 1 second here. Let Caviar answer his. Answer him first, and then I'll switch to that.
Oh, yeah, no worries, bro. I was just gonna ask if you're trading one con because you can't scale out. Of course, you're trading one con. You're just trying to get your strategy down. Are you just taking it at a certain percentage? Let's say my exit is between 20 to 25 in every play, just trying to gain that momentum. Or are you still playing the chart tough like I know like you can still do?
It's different with one con. You have to be very aware of what's going on when you're only trading with one contract, and you don't have the ability to scale out or scale in and average down and average in. So I personally with one contract, yeah, I would probably stick to the at 20% take profit or 25%, whatever you're comfortable with. But obviously, I would work on compounding those gains and building up enough capital to where you can start taking positions in 1/3 and take at least 3 contracts, right? That's your ideal, so that you can add one and then add another and then add another, right? And this gives you the scalability to average in and then average out as well.
Right. Yeah.
So yeah, so if you're only playing with one contract, I would try and stick to your 20%
Got
take
you.
profits.
And do you recommend that as a beginner too? 'Cause I've heard people kind of say you want to take it slow, like build in. Of course, you guys are experienced, but like having to be able to manage your emotions with, scaling out and all that. Do you recommend just one or?
Yeah, no, 100%. I think as a beginner, it's important that you at the end of the day, you have to build up the capital, right? As a beginner, you should think of this as a hobby, so you don't expect anything out of it. Don't think of this as a job or something that's going to make you a shitload of money, especially when you're first starting out. So, the big thing, especially with people starting out these days, is they'll take their 20%, and then the stock will continue to run. And it'll go 100%, 150%. And there's going to be people that are posting screenshots of them hitting 150%. And, they'll get all emotional about it. But the thing is, you shouldn't be expecting anything out of trading. As a beginner, you should just be focusing on building up the consistency and getting comfortable, trading, so that you can start deploying more capital in. And then eventually you get to a point where now you can consider it either a job or like an actual side hustle. But yeah, I think for beginners, you can take 20-25% to get more comfortable and find out your groove.
But appreciate it, bro.
Yeah, for sure, for sure. All right, so bag holder. What was your question now?
Sorry about that. What I was going to ask is, in Steelarms' discussion, he mentioned something about waiting past 9:30 to 9:45, somewhere around there, because then you're still going to have good volume, and something about Europe closing and all that. So can you just talk about sort of time frames about entering trade at the start of the day?
Yeah. So there's different sessions for our market. So there's a Sydney session, which is the Australia session. That's going to be 4 p.m. to 1 a.m. Then there's a Tokyo session, which is 7 p.m. to 4 a.m. And there's a London session, which is 2 a.m. to 11 a.m. 11 a.m. the London session ends, and that's and your obviously your New York session begins at 8 a.m. But as soon as your London session ends right at 11 a.m., now it's just your New York session. So you're gonna have like a higher surge of volume right around that 11 a.m. area because their session's ending, and you're gonna have a little bit more direction starting 11 a.m. because it'll just be New York session.
I mean, why is there more direction after 11? Because it's New York, like.
Because London sessions is gone now, right? There's not like two different sessions that are open. It's just one. It's just New York.
Yeah. So I mean, they've sort of stopped trading, let's just say at 11, but that just means now, it's just their activity isn't affecting New York. So now whatever you see is just US session and it's cleaner. Is that the idea?
Yes, yeah. So after 11, it's just US session. And it is more cleaner for us, right? Because, I mean, you'll notice if you like go to these charts and look back and study them, you'll see right after 11 a.m., your price action starts to get a little cleaner. You'll notice like several times right at 9:30, you're going to see like a lot of volatility, a lot of ups and downs. Buy stops get taken out, sell stops get taken out, right? All within a 5-minute window from 9:30 to 9:35, right? It's pretty hectic right at open. So you'll notice at 11 a.m. you're going to start to see some direction. Like if the market wanted to make a move, it would be right after or directly before 11 a.m.
Gotcha.
So why do you typically take trades within like the first hour-ish of open?
Because if a setup's there, I'm still going to take it.
For sure.
Like if there's a high probability setup that presents itself, that doesn't mean I'm not going to take it just because it's London session. Like it's the overnight session right now. Fucking what is it? Like is it? No, it's not Asia. Yeah, it's Asia session right now. And if I was a futures trader and I wanted to take a futures trade, I would still take one right now, right? Like if I see a high probability setup come, look, check this out right here. Boom. So we have this swing high right here, right? If we go and touch this swing high, we have bearish structure until we break this swing high. This is a high probability short for me. So if I'm a futures trader, I can take a short right here with a stop loss just above, targeting a previous low. Okay, boom, right there. This is a high probability setup. I don't care what time it is and I don't care what session it is. I will still take it. If I get stopped out, the risk is very minimal. That's it.
What's the difference between the two mini futures for NQ?
What do you mean?
There's an NQ1 and 2.
It's just a contract. Like, let me show you. So NQ2 is your next contract, and this is NQ1 is your current contract. It all looks the same. I don't really know like the exact difference between. And then there's obviously all of these like NQU, Z, H, M, U, Z, fucking whatever, all this shit. I'm not a big futures trader, but yeah.
The way that I understood it is that each of those numbers represent a different expiring month. So the NQ1, usually the current month, so we're in June, so it's going to represent June, and then 2 is like July, and 3 is all like something like that.
Yeah. So you'll see here. Well, yeah, and then the alphabet code. So U is September, Z is December, H is March, M is June, and then U back to September. So you see how that goes.
Yeah, makes sense.
Hey, Key, I've always wanted to ask, and this is a dumb question, why the color scheme and any reason behind it?
No, I copied this color scheme. It just
Okay.
looks cool. I have so many color schemes. I have this one, and then I have the other one that I showed you guys earlier, the ICT one. But yeah, I have tons of color schemes. Like this one's kind of like appealing to the eyes. Wouldn't you agree?
It's very neutral. It doesn't like freak you out.
Yeah. No, that's I like to think that like a good color scheme makes me a better trader. So I like to stick with these color schemes.
The red candles and that definitely hit psychology. So that one I know for sure.
Yeah, man. Any other questions?
Nothing more from me, Key. But thank you so much for hosting it. This has been amazing. I can't wait for the recap.
Yeah, 100%. I'm gonna stop